Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us as always. Coming up on the show today, Colin Chazinski, Chief Market Strategist at SIA Wealth Management, will be joining us for the hour. We'll also dig into NVIDIA's latest results after the chipmaker posted a clean beat. We'll discuss more with CJ Muse, Senior Managing Director and Senior Analyst in Equity Research at Cantor Fitzgerald. And of course, we want to hear from you this morning on First Call. Reach out with your questions on technical analysis of North American and global stocks, and we'll have Colin answer as many of those questions as he can at the end of the show. The number to call will be 1-855-326-6266. We'll open the phone lines in about 30 minutes, and our email address is firstcall@bellmedia.ca. Now, some of the stories we are tracking for you in the BNN Bloomberg newsroom. NVIDIA beat expectations for first quarter profit and revenue. The chipmaker also boosted its sales forecast for the second quarter. The tech giant has authorized an $80 billion U.S. share buyback and raised its quarterly dividend. Results indicate an attempt to diversify NVIDIA away from giant data centers, with CEO Jensen Huang emphasizing the significance of physical AI, including robots and automated vehicles. Shares of Walmart are down in the pre-market, 2.66% right now. The world's largest retailer missed its profit guidance for 2027. The American company's operating income for the first quarter also came in slightly below expectations. Walmart says benefits from favorable merchandise and business mix were offset by higher fuel costs. On the upside, same-store sales and revenue in the latest quarter saw growth, with global e-commerce sales also rising significantly. The Canada Pension Plan Investment Board ended its fiscal year with a net return of 7.8%. The increase in assets was boosted by income and transfers from the Canada Pension Plan. The returns were helped by holdings in public equities and real assets. The results fell short of CPP's benchmark portfolio, which returned 13.2% for the same period, boosted by heavier exposure to large tech companies. And now our top line story. NVIDIA reported a first quarter beat last night with an 85% increase in revenue year over year. It also has reported approval for an additional $80 billion U.S. in share buybacks. Here to break down this record revenue for NVIDIA and more is CJ Muse, Senior Managing Director and Senior Analyst in Equity Research at Cantor Fitzgerald. And we're also joined by our guest for the hour, Colin Chazinski, Chief Market Strategist at SIA Wealth Management. Thank you both, gentlemen, for joining us. Colin, good to see you as always. And CJ, thanks very much for joining us today to talk about NVIDIA. Was it another near perfect report, or were there cracks or any concerns that you could see?
I guess I'll start. Another great report, 15th consecutive quarter of beat and raise. But, I think that the challenge is that NVIDIA pretty much represents the market for AI, and that there's still concerns around AI infrastructure spending continuing to grow meaningfully in 28. And until we get, clear visibility to that, I think investors are choosing to invest elsewhere. But, if you kind of take the breadcrumbs that they've given you around 2027, they're on track to earning $15 next year or more, which means the stock trades less than 15 times. So, either we're clearly at an AI infrastructure peak, or this stock is incredibly cheap. And we view it as incredibly cheap.
All right, Colin, you want to join the conversation?
Yes, absolutely. We saw as part of this that there was a huge increase in data center revenues. What can you tell us about that and for the outlook for that area?
Sure. So, I think within data center, roughly 50% of revenues came from hyperscalers, and the other 50% came from neoclouds, sovereign, enterprise, and others. So, in the last 3 months, we've seen greater diversification beyond just the hyperscalers, but obviously hyperscalers are important. I would say that Jensen's commentary was a little bit more aggressive last evening, where they obviously dominate training for frontier models, but he came out pretty aggressive, talking about expectations to grow share in inference. And that's where there's, some investor concern around merchant silicon from Google and Amazon becoming competitive threats. And within that bucket, they talked about how strong they were at Amazon, how much share they're taking at Anthropic. And so we do believe that in 26, 27, led by Blackwell and soon Rubin, that they will be a share taker in the inference market. And when the market again, starts to believe that, that will also be positive for shares.
And you see their partnerships growing with like Uber, Hyundai, Kia for that autonomous driving. I mean, we're not seeing the cars. Is there optimism there too?
Yeah, I mean, I think more broadly speaking, they're very excited about physical AI, and as are we. But that will take a little bit longer. But we are at the very early stage of kind of taking off, and autonomous vehicles, and elsewhere, I do think will become an important driver for this story. But near term, it's really more about data center.
And on that note, with data center, they talked in the conference call about something called Vera Rubin. Could you tell us a bit more about that, please?
Yeah, sure. So Vera Rubin is their next generation offering. It will start to ramp in Q3 26. So just a couple months from now. And this is their newest offering. They're now on an annual cadence. Grace Blackwell was prior, now Vera Rubin. And I think there's a couple takeaways here. Number one, this is a 6-chip solution. So incredible, kind of co-engineering to develop a full system stack. And the second part is that it requires, thousands of parts to build this rack. And that's where they have done a great job of securing and locking up their supply chain, far better than their peers, which gives them a competitive advantage, given that compute is entirely sold out, in our view, this year and next. And so Vera Rubin should be another positive for the story, and should confirm that they are the tech leader in AI infrastructure.
And I was reading, are they down to minutes now to build one? Is that where they're at with it, the way they've worked on their chain?
I'd be surprised if it's in minutes, but I would say that, it's hard, assembling a rack is automated, but I think it would be more than that. But on the chip side, it takes, 3 months to go through TSMC's fab. So it's not like, it happens overnight.
No, it's amazing what goes into it, and these guys do it. Is there anybody threatening them right now? We're seeing some market reaction that feels like maybe competition is growing. Do you feel there's anybody threatening them right now?
I think if Jensen were here, he would say that the Google TPU is the competitive threat or a real solution. I would argue that AMD is making inroads as a fast follower, but considering NVIDIA is on this annual cadence of delivering improved performance every 12 months, I find it very hard to see competition being able to keep up with NVIDIA. That said, for specific inference workloads where you have visibility to scale, there are solutions that can be optimized. And one example would be the niche area of decode for inference, and that's where they bought Grok, and Cerebras recently went public. That is a very low latency solution for parts of the inference market. So there's definitely room for competition. But if I think about the leader in the market and the company that I think will remain the leader, that's NVIDIA.
All right, Colin, we'll give you last question.
Sure. So thank you. So NVIDIA also announced a collaboration with global telecom leaders on 6G. Can you tell us a little bit about some of the build out, and if there's any other new sectors that NVIDIA is getting involved in? It seems like they're always out at the leading edge of the next big thing.
Yeah. Well, I think the big announcement last night was selling standalone Vera. which is their ARM-based CPU. And they talked about 20 billion in revenue. And for comparison, we're modeling AMD doing 16 billion of CPUs this year, and Intel doing about 23 billion. And so they're telling you, in the first year of existence, that they're going to be almost as big or as big as the leading player in the CPU market, which is pretty incredible. On the 6G or RAN side of things, that's still kind of on the come. But, I think their view of the world is that telecom at the edge will act as sort of mini data centers. And they want to participate there wherever compute is done, whether it's in the cloud or more local. And so that, I think, is really the genesis of those partnerships. And, I think that will come to fruition in a couple of years' time.
All right, CJ, thank you very much for joining us. We've got to wrap up now, but we appreciate you joining us this morning. CJ Muse, Senior Managing Director and Senior Analyst in Equity Research at Cantor Fitzgerald. And of course, Colin is sticking around for the hour. Up next, we'll take a look at the markets before the bell and discuss relative strength in global equities. See how things are shaping up on the markets, and we'll start with U.S. futures right now. And after that big rally yesterday, it's been dampened a little bit by some concern out of the Middle East and Iran maybe playing a little hardball with the proposed peace plan that was put forward, or said it was put forward. So right now we can see the markets reacting. We've got the Nasdaq off by half, and the S&P 500 off by 0.75 of a point. Off to Asia now. Let's see what their day went like. Look at the Nikkei gangbusters now. Closed, of course, before that news broke. It was up by 3%. Not a bad day for it. Going the other way, though, you can see the Hang Seng and the CSI 300 both off. The Hang Seng by about 1%, and CSI 300 off by about 1.39%. Nikkei was some bit of a semiconductor rally. Just want to get in. South Korea's Kospi surged as much as 7.8%, led by Samsung and SK Hynix, the semiconductors, of course, makers. So big rally in South Korea, but they're often up and down like that. Heading over to Europe, and a red day right now. The FTSE off by 0.3%. And taking a look at the CAC 40, a little more than a half point. German DAX in about the same spot. And again, it's over that concern about the Iran uranium reports that Iran's not wanting to release any of that as part of any kind of an agreement. TSX yesterday, like everybody else, had a good day, up 1.25 points, back over 34,000. So it was surging again yesterday. It's been bouncing back after that little rough ride I had for a few days. There are some of the winners and losers on the TSX composite. Go Easy, which has been on a roller coaster, going up this time, 11.8%. Perpetual Resources, 11.5%. It was up. Vermilion Energy, down 4.6%, and Strathcona Resources and Energy taking a hit, down by 4.9%. Heading to the metals, all are off today. Gold still above 4,500, but off by about a half point. Silver's off by 1.3 and hovering around 75. And copper's off by 1.1 and still at about 6.25 right now. Western Canadian Select yesterday, and continue to see that drop. We'll see what happens with it today, but it was off by 5.7 yesterday to 78.56. And WTI, again, reacting. What's it doing today? Yeah, it's going back up on that news out of Iran. It's up 2.6%, back above 100 a barrel. Well, equities remain firmly in a bull market, continuing to draw capital away from bonds and cash, with technology, especially AI-driven names, leading the latest rebound. We are back with Colin Chazinski, Chief Market Strategist at SIA Wealth Management, for his take on leaders, laggards, emerging markets as well. What's going on around the world? You've got the giant crystal ball for the globe, and let's take a look at the markets in general. What's the general health to you?
Right now, the general health of equities remains very strong. At SIA, we do relative strength analysis based on head-to-head battles between asset classes, between stocks, between commodities. And what we're seeing right now is the three equity asset classes we follow, US, international, and Canada, are the top three in the asset class rankings. And they're all ranked above things like bonds, commodities, cash, and currencies. So right now, the investing environment overall still remains favorable towards equities. It's been favorable through this whole period of volatility. Equities have continued to attract capital. We've had rotation within equity markets, but equity markets in and of themselves have remained very strong. Of late, we're seeing particular strength in the United States. We've also, over the last month, seen strength in Taiwan and in South Korea as well. And those are three of the markets that are most sensitive to the technology sector, to the AI build out. And we've seen them perform very, very strongly over the last month and more, really. But also where we have seen some softness, in particular, despite being in the news a lot, is actually being China. Now, that might be a function of the war and their access to cheap oil from Iran being curtailed due to the war. But we have seen some softness in China and actually in India as well.
And with the U.S. markets, is it tech driving all this, or are we seeing a little more balance?
We are seeing some balance, but primarily it is technology. But we're also actually seeing strength in energy as well. Energy is benefiting from the higher oil and gasoline prices, and then those are the ones that are up really, really strongly. And then we do have some sectors that are up less or a little more neutral. Things like financials are holding in, real estate, utilities are holding in as well. Where we've seen more weakness of late has been in consumer discretionary and in communications.
And with South Korea and Taiwan, is it mostly the semiconductors driving all that? Is there strength elsewhere?
Primarily, those markets are extremely heavily weighted to the semiconductor sector, so that it basically that's pretty much is what it is.
And now with bonds, we had a lot of talk about bonds, and maybe people were starting to move into cash as well. But bonds, are we still seeing an upward trend with it, or is it flatlined? And which ways? Any indicators on which way it might go?
Bonds have started to flatline, and that's a function of we're seeing rising treasury yields, particularly in the United States. Of course, we've got the changing leadership coming in at the Fed, but also inflation pressures have been rising. Now, the one thing we did see this week was both Canada and the UK showed smaller than expected increases in inflation, but it's still rising, but at least it's not rising as fast as people had feared. So at this point in time, it's like it seems as though this broad-based interest rate cuts of the last couple of years are ending, and we're into more of a neutral to upward trend for interest rates, and we're seeing that show up in bond prices as well, to a kind of more of a neutral trend.
And so with bonds, so you see bonds staying neutral for a while then?
Bonds are looking neutral, perhaps a little bit softer, but within a trading range at the moment.
And then China, we don't talk about China that much. What's going on there from your perspective?
I think what we're seeing with China and India in particular is both of them have been consuming oil that was produced by Iran, and obviously the States has set up a blockade, so it's harder for them to access the super cheap discounted oil that they had been in. So when we see who has to now go out into the world market and buy oil because they can't get oil from the Persian Gulf, well, that's Europe, that's China, that's India, and other countries as well. So some of the countries that now have to source more expensive oil than they had in the past, or significantly more, we are seeing some relative weakness in their markets.
And is the money moving within the country, or is it coming out of the country? Does it look like?
It looks like it's coming out of the country moderately for some of those names. Europe is more or less kind of flat, but China and India were showing some weakness at the same time that South Korea and Taiwan have been showing strength.
All right, Colin, we'll wrap it up there, but lots more to talk about. We'll be back with Colin Chazinski to discuss investment themes, including Canadian banks. Time to see what's on the radar for Colin Jasinski from SIA Wealth Management. And Colin, the banks from Canada are showing up first. What are your thoughts on them right now?
Oh, absolutely. Thanks. And so as we do our analysis, we talked previously about at the asset class level, but we also do rankings at the sector level and at the individual company level within countries and between countries. And so one of the areas we're seeing a lot of strength in right now is actually in the Canadian banks have been doing very, very well in the Canadian large cap rankings. There, the top quartile is dominated by the Canadian banks. So they're showing a lot of strength, relative strength within this country. And it's important for us to note next week, we get all the bank earnings. So we'll be seeing how are they doing relative to expectations? What commentary do they have on the health of the Canadian economy? What might they have? Will any of them raise their dividends this quarter? And things like that. And we can see from the chart here, the bank index is up at highs. So they're doing extremely well and attracting a lot of interest from investors.
And just looking at that chart, it's consistent over the last year, isn't it?
Absolutely, it's been very consistent, very well supported, and the banks have just steadily been marching higher.
And what do you, when you're looking at those, when you see those numbers and see those graphs, does it look like that's a continued trend?
At this point, yes. I mean, we look in particular for when you see that 45-degree steady march in an index. It just means it's continually well supported by a lot of investors, including us in our portfolios, and it's showing just good, steady, consistent support. They haven't gone parabolic where people might start thinking, oh, maybe I should take profits. Well, when you're just seeing these steady increases, and investors are willing to continue, it's showing continued willingness to support them from investors.
Is that your favorite angle, 45 degrees? Do you like seeing?
Yes, absolutely. I mean, for short-term traders, the 70s and 80s are nice, but then they also cause a lot of volatility and concern and uncertainty. These really steady 45-degree upward angles are fantastic for long-term investing.
All right, let's talk about semiconductor stocks. They've been on fire. How's it looking from your side?
Absolutely. So at this point in time, the semiconductors have shown a lot of relative strength. We've rotated into them over the last couple of months, and they've done spectacularly well. And we can see here the angle is much steeper. We've had a big rally, but there's also big growth there. So the sector has attracted a lot of attention, and of late we've seen a bit of a pause. And so we're just watching to see now. Well, is this a pause within an ongoing uptrend or a top? It's hard to say. But it has the big spike had raised some concerns about valuation, but at the same time, the trend is your friend until it ends. Relative strength remains very strong, and these continue to be held within our portfolios.
Can we bring that first semiconductor chart back up? Any concerns about how it's surging at the end there, like over the last few months, or is it more in line longer term?
It's still strong over the longer term. We have seen and we see in that case, it's what we call more of a staircase pattern, where you have these sharp rallies and then periods of consolidation at a higher level. But because we see the consolidation at higher levels, it does increase. In that case, it's digesting a larger rally.
All right, but not concerning to you that it's not going parabolic?
Not at this time.
Okay, and one more we want to get in here, senior Canadian energy producers.
Yes, so what is intriguing is I talked about the banks at the top of the rankings. The other sector that's at the top of the Canadian large cap relative strength rankings at SIA is the TSI, is the Canadian energy stocks. And not only are they doing well within Canada, but the energy stocks are doing well relative to their US peers, which I find really interesting, because you go on social media and you hear President Trump saying all the oil tankers are coming our way. Well, the stock market is telling us that investors are very, very interested in the Canadian senior energy names, and particularly the oil sands. I mean, I think the U.S. Seniors tend to be more diversified geographically, whereas the Canadian oil sands in particular are in a extremely stable place politically relative to a lot of other oil energy producing countries, and that matters. And it's showing up in the markets that they are continuing to outperform relative not only to other sectors but relative to their peers in the U.S.
And now it matters in the moment, but any concerns that long term, once things are resolved in the Middle East, which I'm assuming and hoping they will be, people will just go back to the easier way and pulling that oil out of the ground in the Middle East?
Well, we'll see what happens in terms of that. I mean, we've had several weeks now with ceasefires. A deal is at hand, a deal's not at hand, and it kind of is back and forth. So there's still uncertainty. But I mean, at some point there might be a settling. It depends now on where does the oil price end up settling out. Right now, it's leveled off in about a 90 to 110 range.
And that obviously is a very sweet number for Canada, isn't it?
Absolutely, very strong for number for producers.
All right, as we're talking about, oil is moving higher again. Metals are sending mixed signals. Investors keep a close eye on what comes next. We'll have more about that after the break with Colin, of course. And our phone lines will open soon for our first call segment. Reach out at 1-855-326-6266. You can also send us an email, firstcall@bellmedia.ca. Shares of Stellantis are down in the pre-market as investors show some skepticism about the automaker's $70 billion turnaround plan. The major reset includes focusing about 70% of investments in key Jeep, Ram, Peugeot, and Fiat brands, and sidelining Chrysler, Alfa Romeo, and Opel. The plan also includes a new savings goal and aims at boosting profit and raising returns in North America and Europe by 2030. Shares of IBM are up in the pre-market. The Wall Street Journal is reporting the American company will receive $1 billion US as part of the Trump administration's investment in quantum computing. The government is pledging a total of $2 billion, with a grant also going to Global Foundries, which is developing specialized chips for quantum computing. According to the report, the funding will give the government a stake in the companies. The Canada Pension Plan Investment Board ended its fiscal year with a net return of 7.8%. The increase in assets was boosted by income and transfers from the Canada Pension Plan. The returns were helped by holdings in public equities and real assets. The results fell short of CPP's benchmark portfolio, which returned 13.2% for the same period, boosted by heavier exposure to large tech companies. Oil prices are climbing back above 100 a barrel as investors refocus on geopolitical uncertainty and tightening supply dynamics. At the same time, gold and silver continue to ease on softer inflation fears. And let's get more now on the commodity markets with Colin Chazinski from SIA Wealth Management. Colin, thanks for joining us for the full hour and talking about commodities. We were chatting a little bit about some of the larger Canadian companies, just bigger picture now with oil anywhere in the $90, $100 range. Your thoughts on what direction that's heading?
Right now, it's been. So before the war, we were trading around $65, $75 a barrel, and when the war started, we had this huge, very quick run up to about up over $100 a barrel. And then especially since all these ceasefires and rounds of peace talks started, we've seen the oil price really level off in kind of a $90 to $110 range. And right now it's trading just above the middle of that. So until we see any kind of a substantial shift in direction in the war, it seems to be settling in this range. And as I had mentioned previously, within our relative strength rankings and our funds, this has been a very, very supportive price for energy stocks and the energy stocks that we've been holding in our portfolios.
And what about other energy source like natural gas, things like that?
Natural gas has been a little bit mixed, but we've seen certainly gasoline has been following the oil price, and we've been seeing that not only in the markets, but certainly we've all seen it at the pumps as well with the large increases, and that certainly flows through to the producers as well as in the States. Of course, you also have the midstream companies, and within the States, it's been interesting because relatively speaking, their service companies, their drillers, and their midstream refining companies have been among the stronger performers.
And if this settles down in the Middle East, how fast will we see things return the other way? Can we base this situation on any other previous oil shock?
That's a great question. I think you would probably see oil come back over time, but it would also take some time potentially to get production back up on stream, to refill storage, to get everything moving again with the drawdowns that we've had. So as we've seen, one thing we've seen is when in the early stages of the war, we saw very large, very abrupt swings in the price of oil. More recently, it's been more steady and measured, and smaller swings in both directions. So it would seem if the war were to end today, we probably see somewhat of a drawdown and then more of a steady decline as production and transit gets back up to speed. But that could take a while.
Mm-hmm. All right, let's talk a little bit about the metals now. Gold. We'll start with gold first. What are you seeing with trends there?
Gold and silver actually peaked about the point in time where the war started, and it's interesting because it was just after the war started that our portfolio started rotated out of the precious metals and more into energy, and we've seen that and that was a trend that had started even before the war and continued, and it's something that has continued. We're seeing gold and silver remain relatively high, speaking relative to their past, but they're not as high as they were back in the winter, and they're kind of drifting down a little bit every day. And I think what we're seeing is that some of the catastrophic fears that had been out there have not been realized. The worst cases have not been realized, and so we're seeing them just quietly come back to earth.
Yeah, silver after that spike has really gone flat, hasn't it? Mm-hmm. Relatively speaking. Now, the one's kind of sneaking up. Copper has enjoyed a little bit of a surge recently.
Copper is very intriguing because it's actually surged up to its highest level in decades, and that's really, of course, great for copper producers and copper producing countries. But at the same time, though, again, we talked about increased costs for China. China is a huge consumer of copper as well. So not only are they paying more for energy, but also paying more for copper, which is another key raw material for them. So it is places where, and copper is used in so many things, that's another place where we could see inflation start to creep its way into the system. The flip side of that is the reason why there's the copper price is doing so well is because it's indicative that there's strong demand for copper and that the underlying global economy has remained robust even through the period of the war here.
All right, we're going to take a break on that note there, Colin, but stick around. We've got lots ahead, including market drivers with Bloomberg's Divya Balji. We'll discuss why shares of Walmart are out of favor in the free market. And, of course, our phone lines are open. Colin Jasinski is taking your questions on technical analysis of North American and global stocks. Reach out to us, 1-855-326-6266. Email firstcall@bellmedia.ca. To take a look at some early market movers, and for that we're joined by Bloomberg's Divya Balji, managing editor for breaking news in the Americas. Divya, thanks as always for joining us. How are you?
I'm good. How are you, Roger?
Most excellent. Maybe not as good as Walmart, but Walmart had a good quarter, didn't it?
I mean, it is an interesting one. It did have a solid quarter. It is maintaining its full year forecasts as well. You know, I would say Walmart is like the economic barometer that I was kind of looking out for at this point. You know, this week is a week of retailers. We already saw Home Depot, Lowe's report. We saw Target report. But Walmart's footprint is so massive. You know, it reaches consumers across all kinds of sectors, essentially. It's not just clothes, there's food, there's all kinds of things that people go to Walmart to buy. And I think this really gives you a look into the American consumer and what they're spending on. Now, their second quarter forecast actually came in below expectations. And I think that is something the market is paying attention to at this point. The CFO does talk about fuel costs impacting their numbers, that they could raise prices because of this. So that also points to the geopolitical tensions that we've been watching for a few months at this point. I think clearly here, when you look at it, and what the CFO has also said, is that the budget-conscious, low-income consumer is really pulling back, and that is what they're paying attention to right now. So maintaining a full-year forecast is a good thing considering the environment that we're in, but that second quarter forecast coming in below expectations is probably giving some investors a bit of pause right now.
Okay, quantum computing stocks are rallying today on the news. The Trump administration has decided where to put $2 billion in the sector.
Yeah, I mean, I think this is also another interesting one. Does it seem like the Trump administration is really trying to continue to be a tech leader and making sure that their American companies are getting the money that they need? $2 billion is not a lot of money. It is 9 companies. The one big winner here, I guess you could say, is IBM. It is getting about $1 billion from the government. They will set up a foundry to build quantum computing chips. IBM is also going to put in $1 billion, so that's $2 billion in total. Now, the rest of the money is going to about 9 other companies. That includes companies like D-Wave. So it's good. That amount is not very big. The government is going to take a stake in all of these companies as they fund their growth. But it's also interesting to see that, yes, there is AI that everyone is paying attention to, but don't forget quantum computing is also a huge part of this. We saw Honeywell, with their Quantinum, if I'm not wrong, if that's how you pronounce it, that company is supposed to go public as well. So is that shift happening now where people are paying more attention to quantum computing, or are we still going to pay a lot of attention to AI, and that's where most of the money is going to go?
And I think a lot of people are just slowly starting to wrap their heads around AI, and then to get into the quantum computing is just another world. I got a couple of friends who are into it, and I shake my head at it sometimes. Okay, SpaceX, how can we not talk about it? The IPO.
Yeah, I mean, the long-awaited, public filing of its IPO has finally happened. I did want to shout Roger to the moon, because that is the one phrase that people tend to use when it comes to these types of things. Its valuation, what people are expecting, is about $2 trillion. I think what's really interesting here is the fact that you finally get to take a peek at its financials, like its official financials that you can now see. $4.3 billion of a net loss against $4.7 billion of revenue for the first quarter. I think that sort of tells you how much spending is going into SpaceX by Elon Musk. That is one element of this. We do get to see a lot more of the numbers and what they're generating, what they're spending, what they're actually making in terms of a revenue. I think the other part here is also, what does this mean for the other massive private companies that are looking to go public this year? You have OpenAI. I think the last valuation we heard on that was $1 trillion. You also have Anthropic. What else are we going to see in the IPO market this year? How much of money is going to go into this? Will investors be clamoring? Will they get tired after SpaceX? Sometimes it's good to be the front runner in these things. Sometimes it's better to wait and see what that trading debut, that historic trading debut will look like when SpaceX does go public.
And of course, it will likely make him a trillionaire. On paper, of course. So no big deal.
Yes, it's possible. It's totally possible.
All right, we'll wrap it up there, Divya. Thanks as always. Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a bullish call on Lumina Metals. Let's take a look at some of the notable analyst calls and recommendations. Morgan Stanley has initiated coverage on Lumina Metals with an overweight rating and an $18 price target, representing a potential 48% upside from recent closing prices. Following a $400 million IPO, analysts are bullish on the company's zero debt balance sheet and high-grade copper projects in Poland. Some relief today for Occidental Petroleum shareholders. Goldman Sachs has upgraded the stock to neutral after previously keeping it on a sell rating. The analyst raising their price target on the energy firm to US 64. Goldman says management's strategy to drop its absolute debt down is paying off thanks to strategic asset sales and a strict focus on free cash flow over massive mergers. Turning to infrastructure, CICC initiated coverage on Quanta Services with an outperform rating, setting a price target of $872 a share. Analysts cite the company's booming utility and grid modernization business as a major catalyst for long-term growth. A billion-dollar bill is heading Canada's way for the World Cup. CTV's Andrew Johnson has more on how that stacks up against other host countries.
With the transformation of Vancouver and Toronto into World Cup cities just about complete, excitement is building.
I think it's great to see the festival here and all the games and everything coming into town. Money well spent.
A cost that's now eclipsed $1 billion, according to Canada's budgetary watchdog, to host 13 games in June and July. That's roughly $82 million per game, which is actually less than Russia spent to host in 2018, Brazil in 2014, and South Africa in 2010. But one sports economist points out co-hosting alongside the U.S. and Mexico, what we're paying for doesn't quite compare.
We're not getting any of the major elimination matches. We thought that if we were hosting the World Cup, we would actually see something of consequence.
Close to $500 million for FIFA is coming from Ottawa, the rest provincial and local, to pay for security, infrastructure, and stadium upgrades. The host cities are counting on a big benefit. BC's premier says the tournament will bring 1 million visitors to Vancouver over the next 5 years. The mayor has led the charge.
This is an amazing opportunity. It's going to be a month-long commercial.
Critics claim otherwise.
I've been saying for 8 years now, give or take, that we were sold a false bill of goods, not by FIFA, but by our politicians.
How do Canadians feel? Well, the latest polling from Leger showed close to 3/4 of Canadians support hosting World Cup matches, but a majority indicated their biggest concern is taxpayer costs. And the final number isn't in yet. Andrew Johnson, CTV News, Vancouver.
When we come back, Colin Jasinski takes your questions on First Call. Time for First Call. First email, and that comes from Len. With the recent reduction of the Pizza Pizza dividend, is the stock a hold or a sell? Colin.
At this point, the stock is rolling over, and it looks like a long-term uptrend has shifted to become a downward trend. We've seen it break down quite significantly over the last few weeks. The shares kind of topped out in March, and then they leveled off for a little while, and then kind of we've seen the bottom start to fall out from under them. So they've taken out support near 1350. The next support in a meaningful way is down closer to 11. So there's still some potential downside for the stock, and as mentioned, the dividend has been reduced as well, and we have seen weakness in consumer stocks, in particular, with spending potentially getting shifted from optional things over to necessities, like particularly gasoline. Spending more money at the pumps, we don't have as much money for everything else.
And where do you see the support at 11 coming from?
The support at 11 is held through much of the last couple of years. Actually, it was a resistance level for a long time, and then after a breakout in early 2023, it's acted as a long-term support level. So that's been a key inflection point for the units for a long time.
All right. Next email is from Glenn. I want to invest more in Canadian oil companies, but don't know if I should buy now or wait for lower oil prices with probably lower stock prices. Your thoughts, Colin?
Well, I looked here at the chart I've been looking at is the BMO Equal Weight Oil and Gas Index ETF. It's ZEO on Toronto. And as we looked at it, through periods of ups and downs in the oil and gas price, and really mostly downs for this most of this 3-year period, we could see that, yeah, you've had some swings, but at the same time, it also has generally been going up over a long period of time. So something we can look at when somebody is looking at, so I'm wondering if it's going to go up and down. You can start with a half a position to hold for the longer term, so that if it goes up, at least you own some, and if it goes down, then maybe you can take advantage of that, or consider doing regular purchases over a longer period of time, so that you average your price out, because it's challenging to pick out the exact highs and lows at any point in time. And as I said, the trend is your friend till it ends, but we don't know when the trend's going to end. So on that basis, it's worthwhile to just be steadily investing over time rather than to think I'm going to catch something in either direction.
All right, we got about 30 seconds for our last email from Leonard. I'm interested in your outlook for Allied Properties REIT as they repair the balance sheet.
Allied Properties REIT is one that's been struggling for a long time. It looks like it's bottoming out here. It's kind of stabilizing in this 9 to 11 range. At this point in time, it would still look at something more like collecting the income, and with hope of potential upside in the future at some point. But it hasn't broken out yet. Right now, it would be more of a sit and collect the income kind of stock.
And then leave it at that.
Mm-hmm. And see what happens.
And see what happens with it. And overall, that sector.
Overall, with the REIT sector, generally, what we'll be watching for is to see is where is the trend in interest rates going. Are we seeing if we do see rates start to rise, that becomes a headwind for the sector. If interest rates stay low in Canada, and if the economy remains as it is or improves, then that can be good for the underlying income. So there's a few different moving pieces for the group.
All right, got to wrap it up there, Colin, but thanks as always for joining us.
Thanks for having me.
Colin Chazinski, Chief Market Strategist at SIA Wealth Management, for joining us today. The Open's next. Trading gets underway about 30 minutes from now.